how I saved a self-employed business owner $340,000 in taxes. It's a super complicated plan. For me, it's pretty simple. I'm Jacqueline Matoza. I've been working with Fortune 25 executives and Fortune 25 companies since 2006. I do tax planning and I've saved trillions of dollars over the course of my career. I am going to break down how I save people money. I am a CPA, a retired CPA. I am not your CPA. So this is technically not advice, and you need to work with your CPA to make it so. A couple of facts that are really important to know. My client's a married filing joint taxpayer. He has business income and a little bit of W-2 from his business. His itemized standard deductions, all of that stuff doesn't change. So we kind of shortcutted our example. We go from adjusted income to post-plan adjusted gross income. We'll calculate the difference and show you the tax impacts and how we were able to do this. So I had him come to me and he said, hey, I pay way too much money in taxes. I said, cool, how much is your business making? He said, my business makes $1,397,000. I was like, wow, this is gonna be fun. Unfortunately, we could not convert him into a C corporation because he owned a bunch of real estate in his S corp. So the built-in gains would cause a taxable event. So we could not change his legal entity structuring. This is why you need to be careful with an S corp if you have a highly valued business, or if you have real estate owned by an S corp, never do that. So he had some W-2 income, net his AGI, we calculated at $148,087,484, okay? The majority of it is business income. He had some stocks and bonds, some real estate income, blah, blah, blah. So when he came to me here, his total tax was substantially higher. So when we went through, I said, oh my goodness, we've got to get you your adjusted gross income down. The good news with him is 461L is not a problem because he has 1.4 million in business income. We can offset the entire $1.4 million and we're still not facing 461L limitations because his entire total business losses can go all the way to negative $512,000. This is for 2026. For 2025, it was $626,000. So you need to be careful when you're playing with these, but self-employed people, we can wash out a large amount of your income. He had a lot of employees, so we didn't do a defined benefit plan because he didn't want to pay all of his employees. His employees are already in a union and we're already getting paid retirement money by him, so he didn't want to pay more. So there were certain things that we did for him and certain things that we did not do for him. So what did we do and what did he like? He did an oil and gas investment. This oil and gas investment was to the tune of $600,750 invested. It's a lot of money, but he came to me early. He tested it out in Q2. By Q4, he already had his income cash flow. He knew everything was good. He knew the vendor that he picked was good. He knew that he was getting more than 25% returns. So he went hard in November and December, bumped that number up substantially, and is super grateful to this day given the war in 2026. He's made a lot of money. So he made that $600,000 investment. That is a different business, but it's still a business and can offset his business income. Then he did a senior living facility investment. This investment he made was $500,000. So he put $100,500 into a senior living. This one, important, he did this investment as a limited partner, so this is passive. He did that because he has a lot of real estate that's passive, that was cash flowing positive because he'd already accelerated the depreciation on it. So we were managing his buckets to offset all the income in the bucket, so that whole amount is deductible. Oil and gas is always non-passive income. It offsets any active or active W-2, active business income. Stocks, bonds, mutual funds will be passive and go against here. So we're managing the buckets as we go with him. Then we went and looked at his business net income and we said, how do we bring your net income down and help you smooth your cash flow? Because he was in a very high risk construction field where there's a lot of workers' comp, there's a lot of risk, there's a lot of issues with them crashing his trucks and then he gets sued and blah, blah, blah. So what we did is we built him a captive insurance company. And that captive insurance company, the minimum annual payment is $150,000. So he parked $75,000 for the first 6 months into here. This is an insurance premium, so it is tax deductible against this $1.397 thousand of income. The other thing we did was we employed his kids. They were teenagers, they were working in the business, so we put some money in their Roth 401k. So we employed his kids. So that was another $30,300 paid. Then we did some cost seg on his real estate on something new. He rented a new building with leasehold improvements. So we did some cost seg. The cost seg report came back at $42,564. So when all was said and done, we reduced his adjusted gross income by a total of $849,114. So we went from 1.4 of an adjusted gross income down here to 638,370. Again, still positive, nothing is negative, so no 461L limitations, none of that. So when we look at this difference here of 849,114 reduction in adjusted gross income, how do we understand what the taxes saved? We multiply this, it's a combination of the 37% and the 35% because he's married filing joint. He went from 1.4 down to 600,000, different brackets. So this hybrid adjustment here is a tax savings of $308.4 thousand. Then we had state tax savings, the 3.73% rate. We had state tax savings of $31,700. So when you add the 308 with the 301, this is how we saved him $340.1K in taxes saved. So all we did was reduce his business income. We added expenses into his business. We did some other investments because he wanted cash flow while he was working in his business. He didn't want another job. The real estate that he bought is for his business. He uses it in his business, warehouses, office space. So all of his real estate is in his business. So really at the end of the day, he doesn't want to have to do any more. He's got enough on his plate as it is with his lots of hundreds of employees and a high-risk construction business making multi-millions of dollars. So we said, cool, let's do oil and gas. It tested out in Q2, see if you like it. Q4, he saw his results. He got a 26% check and he was like, cha-ching. Someone's gonna make me double-digit returns and I don't have to do a thing. I'm gonna dump $600,000 into that. The senior living facility investment was estimating a 3.2x multiple. So for every $100,000 he invests, he's gonna get $320,000 back. So very large return. That's a little bit longer term. It's a 5-year return. Oil and gas is an annual. The 26% was his annual cash flow. So this is how we saved our clients $340,000. If you are single making $250,000 or more, if you are married making $500,000 or more, if you are a business owner faking your net income by buying cars and stupid things that depreciate and don't want to do that anymore, like my client, call me, click the link below, book a call, let's chat. There's lots of things we can do that can make you more money while you're busy working, and there's lots we can do in your business depending on your fact pattern and what you want to do and your financial goals. So I could save you $340,000 easily.